In today's video, I'm going to simplify smart money concepts. I'm going to help you understand how to actually make money with this particular strategy. I'm going to break down the different concepts you need to consider whenever you're taking your trades and pack out good profits. When it comes to trading, you don't need to know too much to actually start making money. So make sure you watch this video to the very end to know how to apply this and make money. It's not just about the theoretical aspect. It's about using what you know to make money. And don't forget to subscribe, turn on the notification bell so that you'll be notified whenever I upload a new video. Let's head straight to the chat, guys. Alright, traders, so the first thing we're going to consider is the full meaning of smart money concept. Like, what is the idea behind smart money concept? Now, if you check what we have on the screen, it's just a very simple explanation which says SMC is a trading methodology that focuses on understanding how institutional traders, banks, hedge funds, and market makers move the market. So when you want to trade with this strategy, the idea is for you to trade according to how the market movers think, according to how the market movers, get into the market. So that is how you want to be trading if you want to trade with this particular strategy, that is smart money concept. And I've been able to map out some core principles that you need to consider whenever you are trading this particular strategy. So these are the core principles, and these are, I call them my confluences, because whenever I'm taking my trades, I need to see all of them present. Whenever you're trading with smart money concept, you need to pay attention to these principles I'm about to explain. We're going to pick them one after the other and explain them. So we're going to start with liquidity. Looking at what we have here, liquidity in Forex refers to areas where a lot of pending orders like stop losses, buy stops, sell stops are sitting. Market makers and institutions target these areas to fill their positions. Common liquidity zones include swing highs and lows, equal highs and lows, trend lines, order blocks, and imbalance. So let me just use an illustration to explain this. When trading with smart money concept, before you take your entries, we're going to go to the chart and you will get to understand how to point out this on the chart. But I'm just going to use an illustration. So when trading with smart money concept, before you point out a level as your point of interest, make sure that there is liquidity, price needs to sweep before it taps into your zone and then moves to your direction. So this particular consolidation I mapped out here is in form of liquidity. And if you check, this is more like equal highs and equal lows here. So make sure that there is liquidity, price needs to sweep before it taps into your zone and, move to your direction. Because if there is no liquidity for price to sweep to tap into your zone, then just have it in mind that the area you want to take your trades from is actually the liquidity, and that is where you see the markets will stop you out before moving to your direction. So look at this again. Liquidity refers to areas where a lot of pending orders, stop losses, buy stops, sell stops are sitting, and market makers and institutions target these areas to fill their positions. So whenever the market movers, the banks and the rest, where they want to place their order, they target those levels where a lot of traders will be, thinking that price is about to move from there, and they will start placing their trades. Obviously, for example, let's say support and resistance level, whenever price gets there, it triggers whether a sell or a buy. For resistance, it triggers a sell. For support, it triggers a buy. And a lot of traders tend to place their buy order on a support level, their stop loss below, or the sell order on a resistance level and a stop loss above. So all those things, your order, your stop loss, everything you've done around that zone, they are all liquidity. And have it in mind that liquidity moves the market. So when the market movers want to come in, they will have to sweep everyone out to take their positions, because they want, for example, if they want to buy at a cheaper rate, and if they want to sell, they want to sell at a higher rate. So that's why sometimes when a sell is about to happen, that strong impulsive movement, you will get to see a wick to the upside, and then after that there will be a massive drop. And then when a buy is about to happen, you'll get to see a wick to the downside, and then after that there will be a massive push to the upside. So all those things are, the market trying to grab liquidity before the main movement will happen. So make sure you are not the liquidity whenever you are trading. So this is an important concept to consider if you want to do well with smart money concept strategy. So let's look at market structure. Whenever you're looking at market structure, we have key components of market structure that you need to consider, and I've listed them here. But before we go into that, let's look at what market structure means. When we're talking about market structure in trading, it refers to how price moves and forms, trends, ranges, and key levels on the chart. So understanding market structure generally helps traders identify trade opportunities, trade direction, and potential reversals. Now, traders, have this in mind that if you want to trade with smart money concept strategy, you need to understand how to read the market structure. This is very, very important. Same thing with other components I've listed, that is the core principles of SMC. Because once you know how to read the market structure, you will be able to have a clue of the next thing price is about to do. And then you will take advantage of that and make money. So pay attention. So the key components of market structure, we have trends. Now, when it comes to trends, under trends, we have the bullish trend, we have the bearish trend, and we have the range, or you can call it sideways movement. These different trends, you can call them different types of market structure. So when we are talking about uptrend, that is when market is giving us higher highs and higher lows, just like this. Whenever the market is behaving like this, dishing out higher highs, higher lows, higher highs, higher lows, just like this, have it in mind that the trend is bullish. That is for the bullish trend. And then for the downtrend or the bearish trend, that is when the market is giving us lower highs and lower lows. Just something like this. When the market is giving us lower highs, lower lows, lower highs, lower lows, just like this. Just have it in mind that the market is bearish. And then the range or the consolidation or also the sideways movement, that is when price moves sideways, between support and resistance levels, or you can just say when the price is giving us equal highs and equal lows, moving from resistance to support, support to resistance, resistance to support, support to resistance. So whenever price is moving like this is when support and resistance level traders, tend to make a lot of money, because price will just be moving from support to resistance, resistance back to support, just like that. Whenever the market is behaving like that, it's called a ranging market or a consolidation or a sideways movement. So these are the different trends you can point out when reading the market structure. When we go to the charts, I will tell you the trend you need to focus on whenever you're reading the market structure, because you're not meant to trade during some behaviors in the market. So you need to pay attention to when the market is giving you the movement you need, and then you take actions. Checking the number 2, we have break of structure here. This simply means when price breaks a previous high or low, which is signaling a potential trend continuation. So when we're talking about break of structure, I just talked about support and resistance level. So I'm going to map that out again. I'm going to map this out now as resistance and this one as support, so that I can use that to explain break of structure. So when price gets to a resistance level, it tends to push the market back down. And when price gets to a support level, it pushes the market back up. But in a situation price breaks whether the resistance level or the support level, we can call that a break of structure. So if price should get here, instead of pushing down, we now get a break to the upside. That break is what we call break of structure. Same thing is applicable when price, gets to support, and instead of reacting and giving us a push back up, it breaks. That can be seen as a break of structure, whether to the downside. If it breaks a support, it's to the downside. If it breaks resistance level, is to the upside. So it's can either be called support, break of structure to the upside, or break of structure to the downside. So look at it again. When price breaks a previous high and low, signaling a potential trend continuation. So just having in mind that when there's a break of structure to the upside, that shows that the market is bullish. Remember the bullish illustration, higher highs, higher lows, just like that. So when there's a break of structure to the upside, the market is saying that the price is bullish. So what you just need to do is to keep buying. And then when there's a break of structure to the downside, that shows that the market is bearish and you should be looking for more buys. Then when the market is ranging, there is no break of structure ongoing because we are just getting what? Equal highs and equal lows inside the resistance level. I'm going to leave this drawing here because if you check number 4, we have support and resistance level, and I will use it to explain it. Then we have number 3, change of character, which is a shift in market structure. Now look at this. This is more like opposite to break of structure, because when we're talking about change of character, it's a shift in market structure, signaling a possible reversal from bullish to bearish or vice versa. Remember I said whenever market is giving us this type of movement, it means that we are pushing to the upside, we are bullish. But in a situation, price will now come and break a structure to the downside. Remember, it has been breaking structures to the upside, just like this. This is a break of structure to the upside. This is a break of structure. So let me clone this. This is a break of structure. This is a break of structure to the upside. So this shows a trend continuation to the upside that we should keep buying. But then when market will now come and clear the last key level that caused the last break of structure, that is when change of character will happen. And remember I said it's more like the opposite of break of structure, because whenever change of character happens, that simply means that there is a change in market structure. So if the market has been pushing to the upside, we now have a switch to the downside. So if it's a buy, the change of character will bring in sellers. If it's a sell, the change of character will bring in buyers. Now for number 4, we have support and resistance, which is, when we're talking about support, a price level, it's a price level where demand is strong enough to stop a decline. And then when we're talking about resistance level, it's a price level where selling pressure prevents, further price increase. So looking at it here, you can see from here, price was pushing up until it got to the resistance level. We got, a push back down. So the resistance level, it's more like a stumbling block for the buyers, because whenever the market is pushing up, it simply means that the market is buying. And whenever it gets to a strong level, a strong resistance level, that level tends to push it back down, which brings in sellers. So resistance level brings in sellers, while support brings in buyers. These are the things you need to consider whenever you're reading the market structure. How price is reacting to all these key levels. Is it creating new highs, or is it just maintaining equal highs and equal lows, or is it creating new lows, and so on. So that is how you get to know the market trend, the market structure, and then you will know the next line of action. Watch this video to the very end, because I'm going to show you how to apply this on the chart. What you are just seeing here is the theoretical aspect. I'm going to show you how to apply this on the charts and how you can make money with it, because you're not just here to just know the meaning of market structure and the rest. You need to know how to apply this on the chart, use it well, and make money.